Gold is an investment. It is a luxury good and a jewelry asset, and it is also used in technology uses all over the world. I think if you look at it, first of all, from an investment perspective, it is a unique asset class. It's unlike any other natural resource. It's also unlike any other asset that investors put their money in.
Gold has had a very strong and consistent performance over the past 11 years. In fact, over the past decade, it has been one of the best performing assets. And what stands out is that it has not only performed during good times, but also during periods of stress like 2008 or 2011, in which many assets saw negative returns. Gold had positive returns.
Gold is quite unique. It has quite unique properties in terms of diversification. It doesn't correlate with many other assets. When other assets tend to fall in price, gold tends to rise in price. So it has all of these facets that are very useful from an investment perspective.
It doesn't necessarily mean that it has a negative correlation to everything. It just means that it has very small correlations, and that in the portfolio context helps a lot. There's a misconception about gold being a volatile asset. Gold's volatility, in fact, is lower than most equity indices. So not only a single equity, but actually a composition of multiple equities into an index, and it's also lower than commodities. So when you look at all assets that an investor holds, gold's volatility lies more or less in the middle. It's a bit more volatile, and it's more volatile than fixed income assets, so bonds, T-bills, corporate debt, but it's less volatile than equities and commodities and many other asset classes. It has also a very unique property. It's positively skewed. Volatility stemming from negative returns is lower than volatility stemming from positive returns. That's completely the opposite to what happens in equity markets.
The role of gold in modern portfolio construction is threefold. It's hedging against tail risk or negative return environments. It's hedging against inflationary pressures. And thirdly is hedging against currency risk.
Is really when inflation spikes or when you have high pressures in prices, gold really stands out. And that's actually very good because in very high inflationary periods, gold is able to protect and preserve capital.
It's also a hedge against the bigger economic problems that we face today.
When you have tail risk events, when you have systemic risks that are affecting a portfolio, the correlation between gold and, let's say, equities or other risk assets turns negative. And in those periods, typically equities and hedge funds and other assets may be falling. So indeed, gold is providing support.
It is extremely liquid. It is a very deep market. We estimate that it trades in the region of 240 billion a day. So it makes it very attractive as a high quality liquid asset.
When you think about the financial market for gold, whatever is accessible in some sense by investors, you think about private investment and central bank holdings. And collectively, those two account for or amount to $3 trillion roughly. And that is larger than the agency debt market. It's lower than the U.S. Treasury market, but in some sense that's good because again gives gold a sense of scarcity.
You could have anything from 2 to up to 10% of gold in your portfolio, and that will create a more efficient set of assets. It will either increase your returns or it will decrease the amount of risk you're taking for the same amount of return if you have that kind of weighting in your investments.
If you compare two portfolios that are similar otherwise, they will have more or less the same amount of equities, fixed income, cash, etc., etc. But one has gold on it and the other one doesn't. And it doesn't have to be a huge allocation, anywhere between 0 and 10%. If you have a portfolio with gold and without gold, the portfolio with gold is going to perform better when tail risk events happen, systemic risks and so on. So it's going to outperform against the portfolio with no gold, lowering, in that sense, losses or increasing gains.
Gold is not in a bubble. If you look at the diversification of the underlying demand, where that is coming from, as well as the price return over this bull market, it's evidence that it is absolutely not in a bubble.
When you look at actual asset bubbles that have happened in the past, what you see is that gold's performance today does not resemble at all what many of these assets experience, including Nasdaq or silver in the 70s.
Gold, in terms of the amount of gold available, can only rise by the amount of mine production. You can't print it. Whereas, of course, in extreme situations, governments can print lots of money in order to avert economic catastrophe. Whatever the problems are in the West, the ups and downs about gold as a financial asset, there is this huge drive of demand from Eastern consumers.
Gold represents just under 1% of total investable assets globally. So that there is a lot of room for growth on one hand. Secondly, its influence in the global capital markets is minimal by definition.
When you look at the amount of gold held by private investors relative to the amount they hold in all sorts of other assets, the average allocation is usually about 1%, which basically means that some investors may have more, but most of them have nothing. So there's still a lot of room to grow. Gold is still not an over-owned asset.
I do think gold will adopt a new role in the financial architecture post the credit crunch and the economic problems we've seen around the world.
You should have gold in your portfolio as an integral part, as a foundation asset, and from there try to adapt relative to the economic environment. But given that investors hold so little, there seems to be still a lot of room to grow.